Many firms pay cash dividends on a regular basis. The payment of these dividends do correlate with economic times as anything else, and in recessionary times, firms may cease to pay dividends or cut back on the amount they pay per share. Buying and selling of stock is typically done via stockbrokers on organized stocks exchanges like the New York Stock Market or the New York Stock Exchange, or through dealers in over the counter markets like the NASDAQ. When we declare and pay dividends, there is a chronological order. First, there is the declaration date. This date is the day on which the board announces that they will be paying dividends. The amount per share, the last day of record ownership information, and the payment emailing are typically announced. For example, on February the 14th, 2014, Pepsi-Cola announced the following. PepsiCo will pay $0.568 per PepsiCo will pay $0.568 dividends per share to all shareholders on record on March 4th, and payment will be mailed on March 5th. The dividend date, formerly called the X date, is the date that establishes the recipient of the dividend. It is 2 days before the date of record. If you buy stock before the X date, you get any declared dividends. The seller does not. If you buy stock on or after that X date, the seller gets the dividends declared. You do not. In this example, on March 3rd is listed as the X date for Pepsi-Cola. The date of record determines which shareholder who is entitled to receive a dividend. The issuer of the security establishes a list of owners of record on this date. With Pepsi-Cola, it is Tuesday, March 4th, 2014. The payment date. This is the actual date on which the declared dividends is paid. This would be March 5th. There are different types of dividends. These are declared by companies including regular cash dividends, extra dividends, stock dividends, and liquidating dividends. Regular cash dividends are typically paid quarterly and don't vary much from one quarter to the next. Special or extra cash dividends are non-recurring occasional dividends paid by the company after periods of unusually strong performance. Stock dividends are paid in the form of shares of stock instead of cash and are typically stated as a percentage. 25% stock dividend would mean that you would get 1 new share for every 4 shares you already own. And liquidating dividends are issued once a firm has ceased its operations and all liabilities and obligations have been cleared. Some firms follow a residual dividend policy. That means that they pay dividends only from leftover equity after future capital requirements are met. The dividend per share fluctuates from one year to the next under such a policy. An alternative policy that many firms follow is termed a sticky dividend. This policy is which the firm keeps the dividend per share uniform for a few quarters to avoid sending false signals to the market, which could come back to haunt them later. Some further consideration in selecting a dividend policy include the restriction on legal capital. The par value and the paid in excess of par on common stock being used for payment of dividends are enforced in many states to protect suppliers, customers, and employees from going unpaid due to the reduction of capital via dividend payments. There are also restrictive bond covenants that are placed on bondholders to prevent dividends from being paid prior to coupon interest being paid to prevent exorbitant dividends being paid at the detriment of creditors. And cash availability can be a constraint since most lenders do not look favorably on dividends being paid out of borrowed funds. Stock dividends, stock splits, and reverse splits. Stock dividends involves the payment of shares to current shareholders up to the value equal to 25% of the stock's value. Thus, the maximum stock dividend that can be paid is 1 share for every 4 shares held. With stock dividends, there is no real exchange in wealth, only paper transaction is involved. Stock splits involve a conversion of a number of shares and the price by the split ratio. For example, if a person owned 100 shares valued at $40 a share, it will split 2 to 1. He would now own 200 shares worth $200 per share. Worth $20 per share. Stock splits, like stock dividends, do not change the investor's real wealth position. It is merely an accounting given. The reasons for stock splits, including bringing the price within a preferred trading range, it's also sending out signals positively to investors and increasing liquidity and demand for lower price stock. Increased liquidity is due to more shares being demanded and sold when it's trading in a modest trading range. Now, reverse splits are the exact opposite of stock splits in that investors receive a fraction of their original number of shares based on the split. For example, if a $4 stock is split 1 to 3 for every 3 shares that the investor owns, he will now hold one $12 share. The reverse splits are done to put the stock back up to its usual trading range once it has fallen below it, and to prevent the stock from being delisted due to a low price value. Specialized dividend plans. We have stock repurchases, which are done so to reduce the number of shares outstanding and thereby increase the earnings per share. A share repurchase is the same as cash dividends, except that the shareholder will choose how much cash they want by the number of shares they choose to sell. Dividend reinvestment plans are set up so that investors can choose to have their dividends reinvested into additional shares of stock. So with globalization here to stay and the internet spreading its web across most cultures and continents, financial managers and businesses have to be well equipped with the knowledge about business practices, policies, and issues related to investing and managing funds across the globe. So managing multinational operations The complexity of managing multinational corporations increases significantly because of the differences in cultures, business practices, and political systems that are faced with once they operate in foreign countries. The cultural risk arises from differences in customs, social norms, attitudes, assumptions, and expectations of the local society and its host country. There are differences in ownership structure, such as the requirement to set up joint ventures in certain countries and the requirement to increase local participation in ownership. There are differences in human resources norms, such as hiring and firing norms, and different cultural attitudes towards women and minorities in the workplace. Also, local promotions and reward systems may not be consistent with those of the home office and would have to be altered to maintain positive relations with local employees, customers, and government officials. Their the religious heritage of the host culture often can affect the way employees dress and their holiday observances to be honored. Nepotism and corrupt practices in the host country, such as the requirement to hire relatives of government officials as a condition of doing business, and bribery officials to get permits and licenses. These things are considered in This is considered illegal in the U.S. and are normal practices in many foreign countries. There are intellectual property rights, such as those protected by copyrights and patents, may not be honored in some foreign countries and become an issue when considering doing business abroad. Although are being made to alter the landscape of different attitudes towards intellectual property rights, um, treaties much still there's still work to be done. And then you have business risk. Business risk arise from the economic factors such as inflation rates, recessions, and interest rates, and the exchange rate. Fluctuations can be more pronounced when operating in multiple countries. Efficient diversification of such risk factors is a key to your success. And then we have political risk. This stems from changing attitudes of the political leadership towards the multinational corporation, resulting in the loss of subsidiaries or subsidies and the risk of nationalization. Many multinational corporations can defend against such risks by one, keeping critical operations private, which means to maintain key and critical elements of operations safely within the firm, rendering the assets useless in the case of nationalization. Two, financing operations and assets with local money so that local creditors can put pressure on the host government not to naturalize the business. And three, receiving primary input outside of the local economy, without which the assets and operations could have no value. Foreign exchange. With each sovereign nation having its own currency, which of course does not include the euro, which is accepted currency in 16 of the 27 countries of the European Union. Multinational corporations have to track the fluctuations in the exchange rates of various currencies caused by fluctuating economic factors such as interest rates, inflation rates, and productivity. The purchasing power parity. Purchasing power parity means that the price of similar goods is the same regardless of which currency one uses to buy the goods. In the real world, exchange rates are based on the price of a basket of goods rather than on a single item in different countries. In general, the rate at which we can exchange money between currencies should allow us to purchase the same basket of goods in any country with the same dollars. Currency exchange rates can be expressed in direct amounts or indirect forms of money. Direct amounts is the amount of the dollar required to buy 1 unit of the foreign money, or the indirect amount, which is the amount of the foreign money required to buy 1 US dollar. To calculate these rates, the direct or the American rate is the US dollar divided by one foreign exchange or foreign currency. So the American rate on the Mexican peso would be 0.0810 divided by 1 peso. So 1 Mexican peso can buy roughly 8 US cents. Now, if we divide the direct rate into 1, it takes the reciprocal. We get indirect or the European rate, which means the indirect rate, 1 divided by 0.0810, is equal to 12.35 Mexican pesos. So this says that 1 US dollar can buy 12.35 Mexican pesos. The cross rates are used to state the exchange rate between two non-US currencies. These exchange rates the example of this would be the exchange rate between the British pound and the yen. So we can do this in a 3-step process. First, we can convert the pound to the US dollar using the direct rate. We then convert our dollar into the yen using the indirect rate. We now have an exchange rate for pounds to yen via the US dollar. The arbitrage opportunity exists when cross rates are determined by the equation above, by the steps above, or previously indicated. But they do not hold, allowing traders the opportunity to exchange currencies simultaneously and make profits without taking on any additional risk. And lastly, forward rates. These forward rates, or the exchange rates in the future, 1 year from now, depend to a large extent on the current exchange rate and the relative expected inflation rates of the two countries. Using forward rates, investors and companies can use these forward contracts to essentially minimize the risk of losses arising from having to convert money received in foreign currency at lower rates. The forward rate is the rate that is being committed to today for forward delivery of the currency. So if the rate goes down, you will still get the forward rate that was agreed upon. According to the international Fisher effect, the real interest rates are equal across all countries, so that if we get a higher rate in one country, it will be offset by a higher inflation rate in that country and a weakening exchange rate. And now our transaction, operating, and translation exposure. Fluctuations in exchange rates cause a firm's future cash inflows either from remittance from the customer or from profits being sent home to vary significantly, leading to possible losses and gains from transactions, operations, and translation exposure. Transaction exposure is the potential loss in home currency value of future foreign exchange payments. This loss would occur if the home currency gets stronger, meaning fewer units can be purchased per unit of the foreign currency. This exposure can and must be hedged by selling the currency forward, selling the forward contracts, whereby the forward selling price of the foreign currency can be received as being agreed upon today. Operational exposure is the risk associated with the effect of unfavorable exchange rate movements on the long run validity of the foreign operation of a multinational business, primarily driven by escalating inflation rates. And lastly, transaction exposure is the risk of negative effect on financial statements due to, translational exposure is the risk of negative effect on financial statements due to different countries' rules for translating foreign financial statements into consolidated reports of both foreign and domestic operations.